Hi, my name is Mike Ward. I'm the Global Director of Content at Informa Pharma Insights. I'm here in San Francisco at the Biotech Showcase, which runs alongside the JPM meeting, where obviously the whole of these the movers and shakers of the pharmaceutical and biotech industry come to meet and talk about the year ahead. I'm joined now by Chris Mayo, who is a consultant in the primary markets team at the London Stock Exchange. So, Chris, I mean, it's kind of interesting. This is almost like coming into the lion's den. London Stock Exchange coming to all these bankers and companies and sort of saying, don't list in the States, come and list on the London Stock Exchange. Yeah, how's the story going?
No, I think it's actually fine and it's resonated. We've had a really strong issuance environment in the UK, just as you had in the US over the last couple of years. In fact, it's been the last 2 years have been the best for over a decade. We've seen a number of very significant IPOs. I think also quite encouragingly, what we've seen is a number of companies have IPO'd also being able to come back and raise further follow-on capital. So I think around 70% of the companies that IPO'd in London in this sector in 2014 have already been able to come back and raise further capital. Right. So really what I'm trying to get across to, especially UK life science companies, is that they can achieve their financing objectives by being listed in London. They can access US investors, institutional investors, by being listed in London. You know, the costs are lower. There's a very strong small cap community, in particular in London, so they can achieve all of their financing objectives without having to deal with the regulatory burdens that you face in the US. Right.
So are we talking about the main market in London, or are we talking about the alternative investment market?
Well, we're talking about both, actually, and I think that there's a place for both. I think AIM is a very strong market for growth companies of a certain size. So I would say that companies up to, say, 150 to 200 million pounds of market cap are typically the kind of size of companies that you'll see on AIM. Once you go beyond that, there is no bright line or rule, but companies typically above that level tend to go to the main market. And I think that something that's going to be encouraging going forward is we've seen a lot more private financing, which is something we were talking about this morning at the panel session that we had. And I think that means that companies will be out in the UK will be able to progress to a further kind of stage of development, and that means that a number of them will be ready to go to the main market straight away, much in the way that Circassia did. And I think that'll be a trend going forward. Of course, AIM will also play a part. We saw in Q4, despite the very difficult environment, we saw a number of small cap IPOs on AIM get away for both UK and European companies.
So what sort of money are we talking about if a company is looking to raise money on AIM? What sort of market cap would they be? Valuation would they be going out for?
Well, I mean, the size of companies that we've seen recently have been in the 50 to 100 million pound market cap range, raising something from, say, 7 to 30 million pounds. That's the typical sizes you see on AIM. Once you go beyond that, once you go 75, 100 million pound IPO size, then you're talking really about the main market. It's typically what happens. Although we have seen companies, actually we saw a US company come to AIM in May, raise $100 million, $500 million dollar or so valuation on AIM. So it shows you can do larger IPOs in AIM if that's what you think fits for you.
Yeah, because I mean historically there was always the argument that European companies should actually look at NASDAQ to raise money because there were deep pools of capital here. You get the opportunity to tap into an investor base that is more sophisticated when it comes to understanding the biotechs and pharma space. Does that not hold true anymore?
No, I agree with the fact that you should be accessing US investors as part of your fundraising. Right. The point that I always make to companies is it's actually standard as part of UK IPOs for you actually to access US investors in any case. US institutional investors, I should make that, rather than retail, I should make that clear. So if you look at the shareholder bases of UK-based life science companies, they have significant US investor representation on those shareholder registers. So my point I'm trying to get across to companies is you don't need to be listed on NASDAQ to access US investors. What you do need, though, you need advisors who can help you get the right kind of visibility with those investors. But I agree entirely with the point that you make, Mike, that having those investors as part of your financing round is very important.
But what about trading volumes? I mean, again, there's always a sort of question, is there enough liquidity within, say, for example, some of the, I'll call them smaller exchanges, and I know the London Stock Exchange is not really a small exchange, but in the life sciences space, historically it would have been seen as a smaller player in the marketplace.
With regards to liquidity, I think it's important to point out liquidity again is not a function of the exchange. It's a function of the size of the company, the amount of free float it has, and also the concentration of the shareholder base. So if you have a $100 million market cap company, that's not likely to be very liquid if it's listed on NASDAQ, or if it's listed on AIM, or if it's listed on the main market. So I think people need to understand that better. I think also what they need to understand is that there is a focus perhaps too much on average daily trading volumes when it comes to these, which do tend actually to be higher in the US than they are in the UK. But the flip side of that is that in the UK, the composition of the shareholder base tends to be more institutional, and they tend to hold stock for longer. So I say to companies, what would you prefer? To have a very volatile shareholder base where people are always selling in and out, or would you actually have to have really loyal, supportive shareholders? And I think a lot of companies, when you phrase it that way, actually think, actually, I'd like to have the latter. But in addition, I think it's important to say that a lot of the liquidity in the UK is actually sourced through brokers and is not really transparent through looking at average daily trading volumes. So what we've seen companies who appear to have relatively low liquidity be able to come back and do very large fundraisings at very tight discounts. So that's the point. Where does liquidity matter? Can you raise capital, or can shareholders sell down large parts of capital at acceptable prices? We've shown that in the UK, that is the case, that you can do that.
Because that, again, that's interesting, because in the past, when one would look at sort of, fundraising in Europe versus the US, we saw that Europe usually was about a third of the sort of the global VC money, and IPOs, again, when IPOs are available, the European exchanges were able to do this. The big disconnect was when you looked at sort of the amount of capital around sort of follow-ons, and in the past, the US is, basically, US biotech companies were able to go back to NASDAQ and stuff their pockets with capital. Are you saying now that, in fact, that's in London, it's possible to do these big follow-ons?
I think that's definitely the case. 2015, I think, was actually a banner year for follow-ons in the life science sector in London. So, you've got lots of examples on AIM. Some very sizable deals were done as follow-ons, but also you've got Circassia, who raised £275 million in a follow-on. And in a global context, that's a huge deal for a pre-revenue biotech to be able to do that. And I think it just shows you that there are shareholders in the UK are very supportive, and if you've delivered, they're prepared to come back and back you to fund further development of those programs.
Right. So I can imagine sort of the pitch to European companies is that actually, if you want to tap into sort of the deep pockets of US capital, you can still use the London Stock Exchange as a vehicle. What is your pitch, though? You sort of said you had a US company last year listed. What's the pitch to those guys?
Well, I think it's interesting. I think there is a perception that a lot of UK life science companies go and list on NASDAQ. It's just actually not the case. There were 2 last year, and there were actually 2 US companies that listed in the UK from the life science. So let's call it a score draw for 2015. I think there are a couple of areas which I think resonates for UK investors in particular, and that's why we've been able to attract some US companies. I think one is IP commercialization, where that model's not really that well understood in terms of you have a company which has stakes in a number of different companies. You essentially have a diversified portfolio of life sciences risk. So PureTech is a good example of that. They did 190 million something dollar IPO in London in summer. We had Allied Minds in 2014, also a US-based company in the IP commercialization space, with a lot of exposure to life sciences, who floated, but actually was the best performing IPO of 2014 on the London main market. And also we saw a company actually from about half an hour away from here called Verzion do a $100 million IPO, and that's a platform technology. And I think, again, those kind of companies where they're likely to have lots of different candidates, lots of different opportunities. That resonates quite well with UK investors. I think the other thing from a corporate perspective is the regulatory environment in the UK is much less burdensome than it is in the US. You've got things like Sarbanes-Oxley. Obviously the Jobs Act has helped a little bit with regards to that, but even with that, being a listed company in the UK is not as onerous in terms of the ongoing compliance that you have to deal with, and the cost of that is much better in the UK than it is in the US, and I don't think anyone would argue with that point.
Great. Well, Chris, thanks very much for stopping by, and good luck.
Yeah, thanks a lot, Mike.
Cheers.
My pleasure.
Cheers, thanks.